Hello everyone, welcome to June's Market Review. First of all, let's cover the overview of what we are going to go through today. Firstly, we'll be looking at June's performance, and equities has been doing very well, especially in the large cap technology sectors. They have been driving the performance of global equities. MSCI all country world in an overall has actually risen by about 1.85% for the month. And that said, there was a lot of elections and political uncertainty going on in Europe, and that actually affected the valuations in Europe itself, and did have a little bit of drag in the developed market world. Overall, still, the global equities has been doing very well. As we enter into quarter three, this month in June, we will be also having an overview summary of the performance in the first half. Of course, the global and bond equity was heavily influenced by the large technological sector, as well as inflation rates that's influencing the Fed's decision. And finally, as part of our monthly series on covering major economies' equity landscape, this month we'll be talking about Europe's equity landscape and why it is important to have them within our portfolio. Now, without further ado, let's just dive into the June performance. Okay, firstly, you can see in the MSCI World IMI Index, which cover about 99% of the developed market investable equities, it is up about 1.62. Well, the performance, it's mainly driven by the large technological sectors, especially semiconductor, continuing to drive the fast growth in equities performance. And of course, S&P 500 has plenty of semiconductors companies like Nvidia, Broadcom, and you can see the S&P 500 in fact actually went up by 3.59%. Of course, just now what I mentioned that in Europe, there were a lot of political uncertainty in UK, in France, and even Germany. And these actually lead to a lot of uncertainty within their policies. And what happened is actually it had drag on the Europe equities. And as a result, the MSCI World IMI Index delivered 1.62%, which is lesser than the S&P 500 that tracks only the US top 500 market. Now, if we go into the MSCI emerging market, it delivered an even better result of 3.83%, mainly driven by, again, technological sectors, especially in the semiconductor areas like the TSMC, Taiwan Semiconductor Company, as well as companies like SK Hynix, which are also manufacturing chips. Now, on top of that, within the emerging market, the Indian market has also been delivering quite good results. And as a result, the MSCI emerging market is looking very good in June itself. Now, if we just briefly go into the Bloomberg Global Aggregate Bond Index, we can see that in June, it actually went up about 0.87%. That's because inflation is showing signs of slowing down, and US yield actually fell, and resulting in a climb in the Bloomberg Global Aggregate performance. Now, going into the dimensional equity funds performance in June, we see that compared to the market indexes, the dimensional funds with a tilt towards small and value stocks actually did not do as well. The Dimensional World Equity Fund, which tracks both emerging and developed market, barely moved, whereas the Dimensional Global Core Equity, which tracks the developed market, rose only by a 0.18%. Comparatively, while still doing slightly underperforming the MSCI Emerging Large Cap Core, the Dimensional Emerging Market still managed to deliver 2.34% for the month of June. Now, again, just to emphasize the reason for underperformance in June is mainly because small cap companies hasn't been doing comparatively well than the large cap growth sector. Now, as we enter in quarter 3, let's take a look at the first half performance of 2024. As we all know, because of the AI trend and that optimism has actually driven a lot of these AI tech companies upwards, and the global equity markets has been looking very positive because of them. If, for example, if we take an S&P 500 year to date as of June 30th, we can see that it has risen by about 15.3%. And similarly, if you look at the MSCI the MSCI World IMA Index, because of its other compositions within the companies, aside from the US tech companies, it is actually risen slightly lesser, but still delivered an impressive performance of 10.6%. Now, comparatively, the MSCI Emerging Markets has risen by 7.4%, driven mainly by companies like the TSMC, Taiwan Semiconductor, and SK Hynix, which I mentioned as well. And these semiconductor companies, which help to design AI chips, have actually delivered quite impressive results as well. And overall, the MSCI All Country World year to date have delivered a 10.3% results here. And if we move slightly into the Bloomberg Global Aggregate Bond Index, we can see that it has actually barely moved at 0.13%. Now that's because despite inflation coming down, yield has barely moved. And as a result, you can see that the performance here is only delivering at about 0.13%. Now, going into the first half of dimensional equity performance, we can see that it's not surprising that the dimensional equity funds actually underperform the MSCI indexes. Now, that's mainly because a large cap growth sector has been driving the global equity rally. That said, there is a bright spot here because the dimensional emerging market large cap core fund actually outperformed the MSCI emerging market by about 0.7%. Now that's mainly due to small caps within India outperforming the large cap, and as a result, you can see that the dimensional emerging fund actually delivered about 8%. Now, if we just briefly go to the dimensional global core fixed income, again, it actually barely moved due to the fact that I mentioned yield has not changed much year to date. Reflecting on the first half of 2024, we have seen that the equity has rallied despite a lot of challenges that's going on in this year. And it is true that the small and value sectors has underperformed, but valuations within these AI companies especially has been a concern for many. And it is important to remember that maintaining a diversified portfolio has been crucial to mitigate the downside impact of your portfolio. In this month's series of Equity Landscape, we'll be covering Europe. And first of all, as usual, I'm going to emphasize on why it is important to understand more about the Europe's equity landscape. If we look at the weight in the MSCI All Country IMI Index, which tracks 99% of the global investable market index, we see that while United States holds the highest weight at 63% in equity weight within the MSCI All Country World, Europe holds about 13.3%, which is the second highest in the region in the overall global equity market. And even if we exclude UK, the European Union holds about 9.3%. And hence it is crucial for investors to understand the equity landscape of Europe, which is the second largest within the region. Let me just give an overview of what we'll be covering. Firstly, we'll talk about the diversification advantages of holding Europe equities within your portfolio. And secondly, we'll look at the short-term challenges within Europe and the main the main theme in these short-term challenges, as we have seen in recent news, the Ukraine and Russia war, the energy crisis because of this war, and as well as the political changes that we have seen in recent months. For example, France and UK, which they have now gotten a new prime minister. Now, and finally, we'll be covering the long-term outlook factors, which is Europe's dependency on China's economy, which can be a double-edged sword, and demographic challenges. Of course, this is very common within developed economies, which often see a shift in their demographic age, for example, has been rising. Now, finally, we'll be looking at the savings rate within Europe and showing also signs of an increase in fiscal spending, as we can see on the policies introduced by the EUs. Without any delay, let's go to the first point, which is the diversification advantages of holding Europe within your portfolio. Now, in this chart is a comparison of the MSCI Europe sector forward PE ratio, price to earning, discount versus the S&P 500. Across all the sectors in Europe, its valuation is now cheaper than what it is in the US. And you can see that, for example, if we look at the consumer discretionary sector, which is right here, the current discount of the Europe consumer discretionary sector is almost at 50% cheaper than what it is in the US. Now, in fact, if we look at historical averages, you can see that the consumer discretionary discount towards the US in the past has been around 0 to about 25%. And across the whole sector, right now, this discounted valuation of the euro has been much lesser than the average itself. And this means that in the case of where interest rate is rising, these value company tends to be looking better against companies that have long growth earnings like Nvidia and Broadcom, for example. Okay. Hence, it is important that Europe, which have a generally cheaper valuation, be a good diversification against the US companies, because in the event where interest rate increases, the higher valuation companies tends to be more impacted comparatively to a lower valuation companies. So the question is, why is there a discount of the European sectors versus the S&P 500? That's because there usually tends to be that there are more uncertainties and challenges again in these regions of economy that resulted in investors demanding a higher risk premium due to the higher risk that they are seeing within Europe. Therefore, it is important for us to understand the short-term challenges within Europe, which resulted in this higher perception of higher risk that leads to the market investors demanding a higher risk premium. Now, if we go into the first point, the impact of Ukraine-Russia war on investor sentiment and, of course, the European market valuation. First of all, the ongoing conflict increases economic uncertainties. In fact, we have seen supply chains being disrupted when the Ukraine and Russia war started, and prices has been going up. For example, wheat prices used for making bread has increased quite exponentially during these times. Now, secondly, because of this uncertainties of economic situation, investors would in turn demand higher risk premiums for European equities. And as a result, there is a lower valuation compared to US companies. Now, going to the second point of the short-term challenges, because we mentioned about supply chain being impacted. One of the supply chain is probably the most important, which is energy. In fact, Germany has been largely dependent on Russia's gas supply. The sanctions that's imposed on Russia because of its invasion into Ukraine has actually resulted in Germany having a shortage of energy during the start of the war. And as a result, investors is seeing that Europe is having a issue of energy crisis and has worries about its future supply on where they can get their energies from. And this increasing uncertainty has actually elevated the cost and therefore affecting investors' sentiments on Europe companies. And again, this resulted in uncertainties that decreases the valuation of Europe companies. Political uncertainty within the Europe region has also impacted Europe companies' valuation. Within France, left-wing parties has won majority of the seats, and this actually thrown the current government's pro-business policies into uncertainty. In UK, the Labour government has now become the new party to run the government, and in Germany, right-wing parties have gained much support, which means that the current incumbent party in Germany's future is now more uncertain. Now, as a result of all this political fragmentation and polarization, we are seeing more uncertainty in the future for Europe companies, and this has actually priced in within the valuation that we are seeing. Now, next, let's go into the long-term challenges in Europe. We'll be talking about 3 points. First, the European Union's dependency on China, the impact of Europe's aging demographic on equities valuation, and finally, how higher savings rate in Euro actually benefit it against the US. Now, first, let's look at the first point, European Union's dependency on China. First, let's look at the trade relationship of European Union with China. It is the third largest trading partner in 2023 with an export value of 244 billion US dollars. Now, if we compare that relationship to US and China, US actually exported only 147.8 billion USD to China. This means China has huge significance on Europe's economy. Now, in fact, much of the corporate companies have shown a huge dependence on China's growth. And according to a study by Merics, MERICS, in 2019, of the 25 listed EU companies surveyed, the average revenue generated from China is about 11.2%. Furthermore, if we look at the Business Confidence Survey in 2024, according to European Chamber of Commerce, which surveyed about 529 EU companies, they asked them which are their top 3 concerns on their businesses. And 55% of them ranked the slowing Chinese economy as a top 3 challenge, up from 36% in the previous year. This shows the significance of European Union's companies' dependence on China. Because of this huge dependence on the demand of goods from China, recent years' weak Chinese consumption demand has actually negatively affected the EU's companies' earnings, and as a result, have a dampening effect on the EU equity markets. However, that said, a potential Chinese economic rebound post-COVID could increase the EU's export opportunities as well. So we can see that despite the Chinese economy slowing down, it is in fact a double-edged sword for the European region, because if it ever rebounds, the European Union companies would be able to reap the benefits in China. Now, the share of people aged 80 plus in the EU has increased from 3.7% in 2003 to 6% in 2023. And while on the other hand, the share of people aged 65 plus in the EU region has actually increased from 16.2% to 21.3% in the same period. Now, this means that the median age has actually increased over the years, and it is projected to increase from 45.5, which is in 2023, to about 48.2 years in 2050. We are also seeing similar trends in the UK. How would the increase in average age within Europe impact companies' valuation? First of all, as the age increase, there will be less people looking for jobs within the labor market. As a result, labor supply decreases. And companies which are fighting over talent will see that the talent pool decreasing, and they would need to increase their wage to compete for this talent pool, resulting in higher labor cost, therefore depressing earnings. Now, as well, furthermore, because of the ratio of old age to young age people increasing, this means that the government would need to spend more money or increase their taxes to support these the elderlies, and the increase in taxes in fact would actually decrease consumers' consumption demand due to higher taxes, and also has a dampening effect on companies' earnings due to higher corporate tax. That said, there is a bright spot to this change in demographic. Within Europe, the healthcare sector holds the highest weight of about 16% in the Stock 600 Europe market index. And leading the healthcare sector are two pharmaceutical companies, AstraZeneca in UK and Novo Nordisk in Denmark. They have been seeing their revenue increase due to an increased demand for obesity medicines, diabetes medicines, and healthcare, heart diseases, healthcare and health diseases patients. And as a result, going forward, we are also seeing that it is not just within Europe. In US, Japan, and other developed markets, they are seeing an increase in their average age, and this means that the healthcare sector will be benefiting from this change in demographics globally. If we move on to the final point on long-term challenges, higher savings rate on Europe companies and lower debt to GDP ratio, we look at the savings rate in Europe versus the US. First of all, Europe's savings rate has been higher versus the US. For example, the EU's current savings rate is about 13.7%, the UK 10.2%, while the US is only a small number, a single digit of 4%. Now, what are the benefits of higher savings rate for European companies? This means that there are higher consumer spending potential versus the US. And this potential for spending will result in future booms for companies' earnings. Next, we look at the debt to GDP comparison and the fiscal policy for European region. We see that the debt to GDP ratios in 2023 for EU is 88%, the UK 97.6%, while US is 122.3%. Now, this means that compared to the US, that the EU and UK has more room on fiscal spending. And if we look at if we look at the current situation within EU, for example, we are seeing a change in previous years' government who are implementing fiscal austerity policies to fiscal spending. For example, you can see policies like the Next Generation EU, which focus on green and digital transitions, and much of the companies that are transitioning towards more green businesses are actually benefiting from these initiatives. In UK, the Labour Party, which has recently come to power, has also made promises on increasing spending on healthcare, education, and infrastructure as well. So, what is the impact on European companies? Well, first of all, it boosts demand, and companies beneficiaries from these policies include construction, technology, and green energy sectors. And they also support innovation, especially in renewable energy, digital services, and advanced manufacturing. And finally, higher savings rates and lower debt to GDP ratio provide a robust foundation to increase fiscal spending and support economic growth. Finally, let's go into the conclusion for Europe equity landscape. Now, first of all, the diversification of benefits of holding Europe. It helps to diversify its portfolio versus the US, because within the US, technology sector is more than 25%, whereas in Europe, technology sector is actually underrepresented at 8%, and its biggest sector, the healthcare sector, is about 17%. And in the event, for example, of the AI wave not taking off, in fact, the Europe would be less impacted versus the US sector. And this would actually help to mitigate the downside of your portfolio. Furthermore, Europe has a very good attractive valuations compared to the US, because they are cheaper, and this would actually provide potential for future growth. Now, finally, due to their financial stability, due to a higher savings rate and lower debt to GDP ratio compared to the US, support economic stability and growth, and therefore enhancing portfolio balance. I'll now hand over to my colleague Seth, who will be doing a market debrief. Thank you.
Thanks, Chun Seong, for the market review. I'm Seth, a client advisor at Provident, and I'm here for the market debrief. So in the short term, uncertainty is a definite thing, right? But without certainty, we actually don't have any surprises, whether it's unpleasant or pleasant surprises. We also won't get joy from watching movies or sports, because we already know the outcome. Also, we wouldn't get returns from the stock market if not for uncertainty. So we can't avoid uncertainty, right? So we manage risk, and we do so by diversifying as well as having time in the market. So in the short run, uncertain things like world events such as the US elections, right? We have assassinations, we have old candidates competing to be the most powerful man on earth, and there are also going to be global conflicts that may affect the stock market performance. Also, there may be sector-related uncertainty, such as will tech continue to dominate as they have in the past year or so, right? And which companies will dominate if so, right? Not all tech companies will share in the same returns. So to really look at the stock market's history, we realize that throughout the decades and decades of historical performance, we had very bad recessions and global financial crises, but the stock market tends to go upwards over time and recovers from even the worst of recessions. Okay, and returns can be very random, and research has shown that there's no reliable way to predict the top performance each year. So how do we address this? Okay, we try to go for broad diversification. So the lessons that we can learn from history is that returns across different countries, different sectors and regions, they are random, and a major crisis happens every now and then. The thing is, the market always recovers after a crisis, and the stock market goes up in the long run. Now, why is this so? Okay, because companies will continue to make money, continue to earn, and there's always going to be demand for goods and services, right? A new iPhone is launched every year, and there's always going to be demand for it. And yeah, we still need to use our consumer staples like shampoo, soap, etc. So if you believe in beating or timing the market, the S&P 500 between 1978 to 2019, right, did 8.7% per annum returns. If you miss the 50 worst days, your returns go way up to 16.4% per annum. Conversely, if you miss the best 50 days, your returns drop to just 2.6% per annum, which is a very low figure. Right? In fact, when you react and you react wrongly, it can hurt performance. So just by missing one best day, your performance goes from $21.5 thousand to $19.3. And this is a growth of $1,000 over a long time span of 32 years. And if you miss 25 of the best days, your performance goes way down to just $4,500, right? And that is actually not that much better than just putting your money into safe instruments like T-bills. So missing only a few days of strong performance can impact your overall performance greatly. Now, if you try to beat the bad periods, okay, what happens is that you realize the market has risen in 46 years, it's been stagnant for 3 years, and it has gone down in 18 years. So what does that tell us? Right? It tells us that if you're wrong, you'll be in a very bad shape. And if you try to avoid bad periods, you'll be wrong more often than not. And it is a very stressful way to invest because you're constantly watching the market, you're constantly having to time your trades. And yes, it may take away a lot of time from things that are more important like your family, your job, and other pursuits you may have in life. Now, the market's response to crisis is evident, right? It recovers each time the market goes down sharply, given enough time. And if you look at average returns from a market decline of more than 10%, in a 1-year period, all right, markets tend to recover and do 11.4%. And in a 3-year period, we can expect around 10.3%, and 5 years, 9.6%. So these are the average analyzed returns that we see from history. So some people may think, okay, then I shall sit out market highs and only invest when markets are low, correct? But if we actually look at market performance following market highs, we see also that in a year, market highs can get higher, right, doing about 13.7%. And in a 3 and 5 year period, you still get double-digit returns following market highs. So what is the evidence telling us about the market, right? Is that the stock market will always go up in the long run. Also, to get the best returns, we will need to pick stuff that will outperform and discard stuff that will underperform the market. And we also need to avoid the worst periods and also not miss the best periods. Now, most professional fund managers can't even do this, right? And those that manage to, they actually can't do it for a sustained period of time. Now, to try to get the absolute best performance from the market is a fool's errand. But the good news is we actually don't have to invest this way. We just need to stay invested regardless of market conditions, and we will get the returns we need for retirement or other financial objectives. Markets have rewarded people who have stayed the course, right? Throughout history, things happen many times, and in the long run, the disciplined investor reaps the return. If we look at the entire history of the stock market, right, it doesn't really matter when you invest, because if you invest at the worst absolute period in 1929 when the Great Depression happened, right, you will have suffered a negative 17.1% if you held your investment for about 2 years. But if you held it until 1944, you start to see returns on your investment, and every year thereafter is green, meaning to say that your investment is showing a net positive return. Now, even in more recent times, the 2008 financial crisis, okay, if you invested at the start of 2008, you will see a sharp drawdown of negative 37%. Yet, if you hold it on to about 5 years later, you will start to see positive returns, meaning to say you get your capital back plus some investment return. Now, it doesn't matter when you invest, okay, we have realized that throughout history, there is a safe zone of about 15 years. And if we take the absolute worst recession, the Great Depression, out of the picture, we realize that it only takes 10 years for our investment returns to reach the safe zone, meaning to say there's no more negative returns, right, regardless of what recession we are talking about aside from the Great Depression. So what we need is time in the market. And that's all for the market review. If you have any questions, reach out to your client advisor at Provident, and I'm sure they'll be happy to answer your queries.